There's a phrase that gets used a lot in investing circles. Let your money work for you. It sounds kind of like a platitude, but it points at something real. At a certain point in the wealth building process, the returns generated by your existing capital begin to exceed the new capital you're able to add from income. When that happens, compounding takes over as the primary driver of growth. The account starts doing more of the work than you do. Now, getting to that point requires two things. First, a capital base large enough that strong percentage returns produce meaningful absolute numbers. And second, a method that is durable across different market environments, one that treats down months as part of the process, not as failures. Every equity-based approach will have up months and down months. The question is whether the method, applied with discipline over time, produces dramatically better results than passive investing. That is the growth engine's standard. And that is what the growth engine is designed to produce: dramatic, systematic outperformance of the market over time. Not through prediction or speculation, but through a repeatable method applied with discipline. Fed continuously by the income engine, the growth engine compounds that income capital into a base that grows substantially faster than passive investing ever could. Einstein may or may not have actually said that compound interest is the eighth wonder of the world, but whoever coined that phrase understood something important. Compounding is not about any single month's return. It's the cumulative effect of a strong method applied over years. Down months happen, bad quarters happen. With the right approach, they are absorbed, recovered from, and in some cases actively exploited, as we will see shortly. What matters is the long-run trajectory. We'll put specific numbers on that using the million-dollar experiment shortly. And before we get into the mechanics, let me be direct about something. The broad stock market has returned roughly 7% per year on average over long historical periods. The growth engine is designed to substantially outperform that. In the million-dollar experiment, we target 1.5% per month, compounding to approximately 19.6% annually, nearly 3 times the long-run market average. Your growth engine may target a different rate depending on your chosen approach. What the system requires is that it compounds systematically and significantly outperforms passive market returns, not through speculation or inspired stock picks, but through a repeatable process executed consistently. The accumulation engine, which we cover next, pursues even larger asymmetric returns, but with higher risk and a longer time horizon. Now, the word systematic is the key. Systematic means rule-based, repeatable, and not subject to discretion. You do not decide each month whether the growth engine approach is working and whether to keep going. You follow the process. The process is what produces the outcome, not any individual month's result. In the million-dollar experiment, the primary growth engine vehicle is the wheel strategy. This is a structured options approach that generates premium income from a capital base while keeping risk clearly defined and manageable. It will have stronger months and weaker months. That's the nature of any equity-based approach. It's not the only valid growth engine approach, of course. We'll come back to alternatives shortly, but it's the one that we've chosen for the million-dollar experiment, and it illustrates the growth engine principles clearly. Now, let me walk you through how it works from the beginning, because the mechanics are straightforward once you see the full cycle. The wheel strategy has 2 phases, and they connect in a loop that can run indefinitely on the same stock. Phase 1 begins with selling a cash-secured put. Now, a put option gives its buyer the right to sell shares to you at a specified price, called the strike price, by a specified date. When you sell that put, you are taking the other side of that agreement. You are accepting the obligation to buy those shares at the strike price if the buyer chooses to exercise. In exchange for taking on that obligation, you collect a premium up front. And that premium is yours to keep regardless of what happens next. Now, to sell a cash-secured put, you need to have enough cash in the account to actually buy the shares if you're assigned them. That is the cash-secured part. It means your risk is defined. The worst case is that you end up owning 100 shares of the stock at the strike price you agreed to. Now, if you chose the strike price and the stock carefully, which we'll address in the next segment, that outcome is not a disaster. It's simply phase 2. If the stock stays above the strike price at expiry, then the put expires worthless. The buyer has no reason to exercise it because they could sell shares in the open market at a higher price. So you keep the premium. Your cash is freed up, and you sell another put for the next expiry cycle. You have generated income without ever owning the stock. Now, if the stock falls below the strike price at expiry, you are assigned the shares, and now you own 100 shares of the stock at the price you agreed to, which, because you selected the strike price, is a price that you were willing to pay. You also keep the premium from the put sale. Your effective cost basis is the strike price minus the premium received. Now, phase 2 begins the moment you're assigned. You now own the shares, and your job is to generate income from them until they're called away. You do this by selling covered calls. A covered call gives its buyer the right to purchase your shares at a specified price by a specified date. You are selling the potential upside above the strike price in exchange for premium income today. If the stock stays below the call strike at expiry, the call expires worthless. You keep the premium, and you sell another covered call for the next cycle. If the stock rises above the call strike, your shares are called away, sold at the strike price you agreed to, and you keep the premium as well. Either way, you collect income. The loop closes here. Once the shares are called away, you are back to cash, and you begin phase 1 again, selling a new cash secured put on the same stock or a different one, and the wheel turns. Now, let me put some numbers around this in the context of the $1 million experiment. We target 1.5% monthly on the growth engine capital base. That's a deliberate planning floor that leaves room for quieter markets, thinner premiums, and months where we're managing an assigned position through a temporary drawdown. We will explain the reasoning behind that specific number in a moment. At 1.5% monthly on a $10,000 growth engine balance, that is $150 per month. That's modest in absolute terms initially, but this balance is not static. It's being fed monthly by the income engine, and it is compounding. That number grows. The monthly return then grows along with it, and that's the mechanism. The wheel strategy is only as good as the stocks that you run it on. And this is the part that most explanations of the wheel strategy tend to gloss over, and it's where most people who try the wheel strategy and have a bad experience went wrong. The core discipline of stock selection for the wheel is this: only run the strategy on companies you would genuinely be happy to own if assigned. Not companies you think might go up, and not companies in a hot sector that have attractive option premiums. Rather, companies that you would be comfortable holding for 6 to 12 months if the market moved against you, because you believe in the underlying business. This criterion matters because the wheel strategy's primary risk is assignment. If you sell a cash secured put on a poor quality company and the stock drops sharply, you own shares in a business that might not recover. The covered call income from a stock in a sustained decline does not compensate for the capital loss. The entire growth engine thesis depends on the stock eventually recovering and the wheel continuing to turn. That recovery is far more reliable for a great business than for a marginal one. Now, what makes a company suitable for the wheel in the $1 million experiment? Well, we look for several things: strong fundamentals, a profitable business with a durable competitive position, not a speculative story, a recognizable brand, or a market position that gives you confidence that the company will be still relevant in 5 years' time. We look for a liquid options market, meaning there is enough trading activity in the options to get reasonable prices when buying and selling. And we look for a valuation that is not wildly stretched. You do not want to be assigned shares of a company trading at hundreds of times earnings when the market corrects. And that last point deserves some emphasis. The wheel strategy is not a stock picking strategy. You're not trying to find the next great compounder and hold it forever. What you're doing is generating yield from quality businesses. The stock is the vehicle, not the destination. This means that slightly boring but well-established companies with liquid options markets are often better wheel candidates than exciting, fast-growing companies with thin options liquidity or volatile prices. There's a useful test that you can apply to any potential wheel candidate. If you were assigned the shares tomorrow and the stock then dropped 20% and stayed there for 6 months, how would you feel about it? If the answer is comfortable, because you know the company, you believe in its fundamentals, and you're happy to keep selling covered calls and collecting premium while you wait, then it's probably a suitable wheel candidate. But if the answer is alarmed, because you really do not understand the business, or you bought it primarily for the options premium, well, then it's not a good candidate. The wheel strategy runs best on companies you understand well enough to hold through discomfort. The options income is a feature of owning quality companies and not a substitute for evaluating them. Now, a word about other growth engine approaches. The wheel strategy is what we're using in the $1 million experiment, but it is not the only valid way to compound capital systematically. Value investing, buying and holding quality companies at a discount to their intrinsic value, is a growth engine approach that has produced exceptional results for disciplined practitioners over long periods. Dividend growth investing, where you build a portfolio of companies that pay and increase their dividends annually, is another one. Systematic index investing, with a defined rebalancing discipline, can serve this function as well for some investors. What these approaches share is the systematic quality. Rule-based, repeatable, not dependent on discretionary calls about market direction. The growth engine does not predict. It executes a process. The mentor you choose for your growth engine will largely determine which of these approaches you implement. And the virtual investing organization model is specifically designed to help you find a mentor whose approach fits your situation and your risk tolerance and your available time. Now, every growth engine approach has a version of the same vulnerability. What happens when the market falls? For buy and hold investors, the answer is straightforward. The portfolio declines and you wait. For wheel strategy practitioners, the specific concern is getting assigned shares in a declining market, where the covered call premiums you can collect may not keep pace with the paper losses in the position. And this is a real risk, and I want to address it directly rather than dismiss it. If you run the wheel strategy on a stock that falls 30% and stays down for a year, your growth engine performance during that period will be impaired. The covered call income helps, but it does not fully compensate for a large drawdown. The strategy is not immune to market cycles. What it is, however, is far better positioned to recover from market cycles than a conventional approach. And this is where the interaction between the income engine and the growth engine becomes one of the system's most powerful structural features. Recall from episode 3 that the income engine keeps generating cash regardless of what equity markets are doing. Active trading strategies, the leverage short duration approaches that power the income engine, these can be profitable in rising or falling markets. That cash keeps flowing into the growth engine every month, regardless of where the stock market is trading. Now consider what a market correction looks like inside the three-engine system. The growth engine has positions in great companies temporarily underwater, but the income engine keeps delivering new capital every month regardless. That capital buys more shares or sells puts at lower strike prices, at prices cheaper than the correction. Cheaper than before the correction. The effective cost basis decreases with every additional unit purchased. This is systematic dollar cost averaging funded by an income stream uncorrelated with equity markets. Not the passive kind where you hope your salary arrives at the right moment, but a deliberate structural response to falling prices. Now, when the market recovers, and quality companies and strong businesses do recover because the fundamentals that make them quality companies don't just disappear in a market correction, then the growth engine recovers with it. But it recovers from a lower average cost basis because the downturn was used as a buying opportunity rather than endured simply as a loss. The covered calls on the additional shares generate additional income during the recovery. And by doing that, the wheel accelerates. This is the mechanism that turns the growth engine's apparent weakness, vulnerability to assignment in a down market, into a structural advantage. The weakness only exists if you're running the growth engine in isolation, without an income engine to fund continuous deployment of capital at depressed prices. With the income engine running, the correction becomes a feature of the system rather than a bug. Now, I want to be clear, this is not a guarantee of smooth performance through every market environment. There will be periods where the growth engine is under pressure and recovery takes longer than expected. A deep bear market, particularly early in the system's life, when the capital base is still modest, you're going to feel that. What the system provides is not immunity from that experience. It's a structured response to it. Instead of watching and waiting, you are buying and compounding. And instead of worrying about when the market will recover, you are building a lower average cost basis that makes the recovery more profitable when it comes. That is a fundamentally different relationship with market volatility. And it's one of the primary reasons the three-engine system is designed the way it is. Now let me show you what 1.5% monthly compounding actually produces over time, because the numbers are more compelling than the percentage sounds. Starting from $10,000 in the growth engine, that's a reasonable early stage balance, 1.5% monthly compounding produces approximately $11,900 after 12 months, if no new capital is added. That is roughly 19.6% annual return, nearly 3 times what passive market investing has historically delivered. Now extend that to 2 years, still with no new capital added, and that balance reaches approximately $14,200. By year 3, it is approaching $17,000. The curve accelerates as the base grows because each month's 1.5% operates on a larger number than the month before. This is the back-weighted nature of compounding. The early years produce smaller absolute gains, and the later years produce larger ones. And the only way to reach the later years is to protect the base from the kind of catastrophic loss that resets it back to the beginning. Now add the income engine transfers. If the income engine is generating $250 per month, and half of that is flowing into the growth engine, then that's an additional $1,500 of new capital per year entering the growth engine. The compounding now operates on a growing base, not a static one. The monthly return percentage stays the same, but the absolute dollar amount it generates increases each month as the base grows. This is why the $1 million experiment's 1.5% monthly target is a deliberate planning floor, not a ceiling. In active options markets on quality stocks, the wheel strategy typically yields between 2 and 4% per month, and there will be months below that floor. Corrections, assigned positions, quiet markets. There will be months above it. Over time, the average is what matters, and a month that produces strong average returns over years compounds into results that far exceed what passive investing delivers. Whatever rate your growth engine targets, the principle is the same. Choose a method, execute it with discipline, and measure it over years, not months. Now to recap, the growth engine's job is to compound systematically and substantially outperform passive market returns. In the $1 million experiment, we target 1.5% monthly, nearly 20% annually, using the wheel strategy on quality companies. Now your implementation may target a different rate depending on the approach you choose, but what doesn't change is the mandate. Compound reliably, protect the base, and outperform the market through method rather than speculation. Stock selection is critical. Only run the wheel on companies you would hold comfortably through a downturn. The income engine's ongoing cash flow turns market corrections into buying opportunities, and the compounding that results, sustained, protected, and continuously fed, is what drives the wealth trajectory that the three-engine wealth system is built to deliver. Now, in the next episode, we complete the framework with the accumulation engine. That's the engine designed for asymmetric, venture-style returns on a carefully sized portion of your capital. The growth engine is the systematic compounder, dramatically outperforming the market over time through disciplined method. The accumulation engine adds a different dimension, the chance to capture outsized, multi-year upside on a small allocation that doesn't put the foundation at risk. Understanding how those two engines relate to each other and why the sequencing matters is one of the most important structural insights in the entire system. So remember to subscribe to this video so that you don't miss it. We'll see you then.